Hello again, guys. As you know, my name is Martin Jones and I am talking to you about how to answer a P2 exam question in 10 easy steps. Although, like I say, I'm not sure there is anything easy about P2. Step 3, as you recall, I hope, is looking at Part A itself. We're looking at a question called Kate from June 2010, and step 3, I'm going to read Part A and show you how I would have answered Part A. So we're going to look at Part A. I've got it here just on my left-hand side, and I'm going to show you how I would have answered Part A. Now, I think before I show you the next slide, I want to just read it with you. So here we go. Question 2A. Discuss was the requirement, if you remember. Kate is an entity in the software industry. These questions are often called industry questions. As you might remember, I was calling it a mixed question, but they're also often called industry questions. They're a mix of different subjects within one particular industry. And the industry that the examiner chose for Kate was the software industry. Kate had incurred substantial losses in the financial years from the 31st of May 2004 to the 31st of May 2009, which is the past. In the financial year to the 31st of May 2010, Kate made a small profit before tax. This included significant non-operating gains. And once I guess one is it says, doesn't it really, that if you hadn't have had these non-operating gains, then the company would have made the usual losses that it's been making for years. In 2009, Kate recognised the material deferred tax asset in respect of carried forward losses. Now, there's the first really substantial sentence. The first thing I'd like to do when I'm answering my question is identify that the subject matter is deferred tax, talk very briefly about how deferred tax works, and then show that actually in 2009 the company was right to recognise a deferred tax asset for losses, which sounds a bit of a weird thing, doesn't it? But I'm going to show first of all how deferred tax works, and then from that I'm going to show that because of the way deferred tax works, it does end up with a deferred tax asset when the tax accountant carries forward losses. But reading on, there's a very important part of this sentence that I haven't read yet. Kate recognised a material deferred tax asset in respect of carried forward losses which expire during 2012. Now, I'm working here in the UK, and tax losses here in the UK can actually be carried forward forever. So clearly the question is not in the UK, it's in another country. We don't know what, but what we do know is that those tax losses expire in 2012, which for our purposes just means in the near future. For the purposes of this question means the near future. So, well, how is that important? Well, as we'll see, losses do give rise to a deferred tax asset, but a deferred tax asset is only really an asset if you are going to get the benefit of setting off those losses against future profits. And they call them recoverability, actually. The losses are only recoverable if you get to set off the carried forward losses against future profits. And the company's got to return to profitability within a very short space of time. This question was set in 2010, as I mentioned, and we've got till 2012, which means we've got 2 years. So this year has had a very small profit before tax. It's basically break even. Next year has got to be really profitable, and the following year has got to be really profitable for us to get the benefit of the losses brought forward. And that really is the detail of what the scenario is saying. There's a little bit more in this story, but not much. So let's read on. Let's read that important sentence again. In 2009, Kate recognised the material deferred tax asset in respect of carried forward losses, and we're going to show that that recognition of an asset was correct, but these will expire during 2012, which is a problem because we've, you know, unless the company returns to good solid profitability over the next 2 years, we won't get the benefit of those losses carried forward. Kate again recognised the deferred tax asset in 2010, which is this year, on the basis of anticipated performance in the years 2010 to 2012, which is next year and the year after, based on budgets prepared in 2010, this year. The budgets included high growth rates in profitability. Kate argued that the budgets were realistic as there was positive indications from customers about future orders. Kate also had plans to expand the sales as there were new markets and new products whose development would be completed soon. Kate was taking measures to increase sales, implementing new programs to improve both productivity and profitability. Deferred tax assets less deferred tax liabilities represent a massive 25% of shareholders' equity. As at the year end, there was no tax planning opportunities available to Kate that would create a taxable profit in the near future. Basically, the only way that Kate is going to get its, the benefit of its asset is if the company returns to profitability. And they've produced budgets that do indicate a return to profitability, substantial profitability. But the question is, are you convinced? And I am completely unconvinced. I believe that the company is not going to return to profitability. And therefore, quickly bashing through my answer now, what I've done is a top-down approach. There's my first slide. First of all, I talk about deferred tax, then I talk about deferred tax on losses, and then I analyse the scenario. That's how it's going to be. So, deferred tax. Deferred tax is based upon the following. DT is TD multiplied by percentage, where TD is the temporary difference and the percentage is the corporation tax rate. Basic knowledge. Temporary difference, this has its own equation. TD minus CV gives TB, where CV is the financial accounting carrying value and TB is the tax accounting tax base. So basic knowledge for 2 marks to start with. Then I'm going to show that losses do give rise to a DT asset, and as you can see, what I've done is there's no numbers in the scenario, are there? So I've put some numbers into my own answer to make it easier to show what's going on. Losses. We financial accountants lose losses in equity, but the tax accountants carry them forward as assets. So losses give rise to DT as illustrated by the following. Assuming a loss of 100 million, and I've used exactly the same numbers as I used in the step 2 video, as you can see, to prove a DT asset was correctly calculated last year. And I've said, by the way, negative TD, by the way, the fancy name for a negative TD is actually a deductible TD. A negative TD always gives rise to a DT asset, which I mentioned previously, didn't I? But I'm still talking generally. I'm not really talking about the specific scenario. So now I'm going to drill down to the specific scenario. Asset. But an asset is only recognised if it is a present right to a future economic inflow. A present right to a future economic inflow. In the context of tax losses carried forward, that means tax losses are only useful if they can be set off against future profits. Which comes to the point, doesn't it? Kate itself, but Kate does not look likely to return to underlying profits. Now that's what I think. Now you can say what you think, but I'm saying what I think. Kate does not look likely to return to underlying profits soon because Kate only made a profit this year as a result of non-operating gains. Further, although Kate is trying to make it look like the future is bright, it's not very convincing. I don't believe the budgets. Conclusion, I suggest the DT asset is not recoverable and should not be recognised. And that's how I would recommend you answer that part. A kind of drill down approach. Basic information about deferred tax, more sophisticated information about deferred tax losses, and then very detailed information about the specifics of the scenario. Okay, that's that.